Perfect. Well, listen, I think we'll probably see a couple of more folks trickling in over the next couple of minutes. But first of all, wanted to thank you all for joining. This is kind of a fun investment review that we're going to have today. I think a lot of what we're going to be focused on is the market recap and of Q4 of 2017, which was actually kind of a really exciting quarter.
That was a great quarter.
Yeah, we had a great Christmas present at the end of the year.
Yep.
And so we're going to be reviewing that. But then we're also going to break a little bit and maybe talk a bit about what's happening in the markets today. So as I'm sure everybody's noticed, this last week has not been nearly as exciting in the markets as it was in Q4 of 2017. So we're going to talk through the Q4 performance, talk a little bit about what's happening in the markets today, how that impacts the employees, and particularly the investments that we're looking at. And then we brought in Jeff Schulte, who I think a number of you have already met. Jeff, apart from, well, he was my carpool buddy for about 10 years. He runs our product team here at ForUsAll.
Yep, and I'm excited to be here and share some new product developments that we're working on and give you guys a sort of a preview into some enhancements that are coming out soon.
So as always, this is really meant to just be an open conversation. So as we're going through any of the material, please feel free to jump in with any questions, comments, things that you like, things that you're concerned about. Love to hear all the good and the bad. So that's maybe for the intro. In terms of the agenda, we'll dive into the investment review and then talk about the product developments. Maybe kicking it off, let's talk about the last few days.
What's on, I think, top of most people's minds right now, which is what's been happening recently. And just want to make sure everybody can see our screen. We are presenting some slides here. So, David, what has been happening in the market?
Well, it's been an interesting couple of weeks. So right here we just have the Dow and the S&P over the last few days, and it's been a pretty phenomenal decline. Definitely not something that many of us expected, because we actually ended last week with some really good news on both the economy and then also, oddly enough, there's like a budget. Our government actually has a budget.
Right, so that should be good news.
Should be good news that we're not facing more risks of more government shutdowns and turmoil. But paradoxically, it seems like the market has responded quite negatively to a lot of this.
Right, so can you explain a little bit about what's going on there? Why is stuff that appears to be good news having this kind of impact?
Yeah, so there's been a number of issues. First and foremost, a lot of the data that came out last week, also some of the new budget, both of them are really increasing inflation fears in the market. This is, we're exiting or potentially exiting a period of really long, sustained low interest rate environment. And when interest rates were so low, that really was a strong buoy to stocks for two reasons. First, nobody wants to hold a bond that's just paying a little over 1%. That's not too exciting.
Okay.
Secondly, that really lowered the borrowing costs for a lot of companies and allowing them to take on significant leverage to finance their own growth, resulting in more profits, higher stock prices.
Okay.
With the jobs report that came out last week, we saw that if you're an American worker on Main Street, times are actually getting pretty good. Wages started to increase, overall payrolls were increasing, but they were increasing at such a rate that many began to fear that was a sign that inflation was just right around the corner. Usually wage growth is one of the first things that influences the increase in other prices that form the CPI, which is the measure for inflation. Now, we also have a new Fed chairman coming in. And I think that's leading many to think that the Federal Reserve might become a little bit more aggressive in raising interest rates going forward, particularly if we continue to see more signs of wage growth and price inflation. If that happens and interest rates do begin to rise, then the concern is Those two things that were great for stocks are going to go away. It's going to be harder for companies to raise money. It's going to be more expensive for them to do so. And that might impact how much they're reinvesting into their own growth. Secondly, bonds are suddenly going to become a lot more attractive to stocks.
Because interest rates go up.
Because interest rates go up.
Okay.
Yeah, and if you can get a higher return than you used to on a guaranteed bond, then why not? Why take on that additional risk? And so those were two of the factors that were really leading to a lot of the volatility that we've seen in the stock markets. The markets have gone up so much, even with this decline. It's still very positive for the last year. But depending on what time you looked at the market today, we were on track to have one of the worst weeks in the market since 2008. And I could remember, back in 2008 and 2009, Jeff and I, we were managing mostly Fortune 500 401k plans. And those were very scary times.
Some difficult times.
And particularly for employees.
Scary is the word, I think, that you said. And I think that's right. For employees, it was scary seeing markets going down that much.
Yeah, and I think when we'll talk a little bit about this later, but the investments that were chosen and recommended were not just simply recommended based on how they were expected to perform in great times, but we paid a lot of attention to how do they perform in really bad times. And I think the Vanguard target date funds, which hold the bulk of the assets in all of our 401k plans, are really structured to do well both in good and bad times. And so we'll talk about how that played out historically and how they're positioned today to mitigate some of the stock market volatility. So that's the first part. The second part is, here at ForUsAll, we do believe that one of our primary roles is to help employees make smart decisions. So earlier in the week, when volatility really spiked, we began to do some proactive outreach to your employees. And we're going to continue to do so as the market works its way through the current levels of volatility. So let me pause there for a second and just open it up to everybody on the call. Any other thoughts or questions about what's happening currently in the market? Okay. Well, feel free to either unmute yourself and voice your question, or you could always just type in a message into the chat, which is on the GoToMeeting control panel, and then we could address your questions that way.
So just a quick recap, though, David. For employees that have been watching this, what should they do with their 401k?
So I think the same thing they were doing before this happened, which is continue to focus on savings. Don't get too worried about any bumps in the road along the way. A lot of employees, especially when I think about a millennial, they're going to go through probably 10 or more of these market downturns before they get to retirement. Some of them won't be that bad and they'll be pretty short. Some of them may be like what we saw in 2008 and 2009. But the important thing is to really stay in the market. The biggest harm that was caused by 2008 and 2009 were really those employees that actually cashed out of equities, sat in cash on the sidelines.
Thinking they were being conservative and then missing out when the market actually does recover.
That's right.
Okay.
So let's look at the investments. So going back to happy times that were just a couple months ago. So when we looked at Q4, really across the board, it was a great quarter. Everything from the US to international and emerging market stocks were up quite significantly for a quarter. Similarly, bonds were doing pretty well. Both the Barclays US Ag and the global bonds, both of them showed strong performance during that period. So jumping to the investment performance for a moment, we like to start by looking at, well, how are employees invested across all of the different investment options that they have? And when we look at terms of total dollars, basically more than 75% of all dollars in our 401k plans are invested in the age-appropriate target date fund. That means that from a dollar perspective, 75% are in age-appropriate, diversified portfolios at an appropriate risk level. When we look at it by participants, it's actually much higher. It's closer to like 85 or 90%. So the vast majority of employees are well positioned in these age-appropriate funds. But we also always want to take a look at, well, what does those that aren't in the target date funds, how are they invested? And this continues to look really well. Across those employees that are self-directing their own accounts, it's still in aggregate is quite a diversified portfolio. So you see here that approximately 87% of all assets are invested in equity funds or stock funds, with about 13% in bond funds. When you look at the split between the stock funds, it's exactly kind of what you would expect to see. A huge allocation to the total stock market index, fair amount in the small, mid, and international stock indices. So it's exactly the type of mix that we would generally want to see, diversified, not just focused in bonds, but really spread across the different types of asset classes that are in the 401k plan. So that's the great news, is that in aggregate, those that are self-directing have a great diversified portfolio. And then when we look at the participants or the assets, the vast majority are in an age-appropriate target date fund. Which then leads us to ask the question, well, how did the funds perform? And for those of you who I see join many of our investment committees every quarter, it's basically the same story, which is...
I remember the first time we did this, you said these would be the most boring quarterly investment reviews because it's going to be extremely consistent quarter to quarter.
That's right. And this quarter is no different. So what we always like to say is over the quarter, over 1 quarter period, it's always a toss-up whether or not the low-cost index funds are going to outperform the median fund. But really, when we begin to look at the longer time periods, that's where you tend to see the low-cost institutional index funds begin to outperform. And it's happening for 2 reasons. First, their fees are just a lot lower, and every dollar they don't pay in fees is a dollar that your employees get to keep in an extra return. Second, the more expensive actively managed funds tend to take some pretty significant active bets. And sometimes over the short run, it's a coin flip. Maybe the bets pay off, maybe they don't. But those bets always introduce extra volatility, all else equal, to those funds, and that extra volatility over time can be a real drag on long-term performance. So let's look at the 2 large cap stock funds. So here we have the Vanguard S&P 500 fund and the Total Stock Market Index fund. Over the quarter, it was 50-50. One outperformed the median fund, the other slightly underperformed the median fund, but they were all pretty close together. But when you look at the 5-year and the 10-year, you see them really pull ahead upwards to, over the 5-year period, you're almost looking at about 1 to 1.25% outperformance. And over a 5-year time period, that's actually pretty significant. That's like 7% more money at retirement in those funds. We took a look at the mid cap, same sort of thing, basically neck and neck over the quarter. But as you look at the longer time horizons, the Vanguard really begins to pull ahead by equal margins. Small cap fund, well, they
did well this
flipped the
quarter.
coin.
Yeah,
they did better over
yeah.
the quarter.
Yeah.
But again, you see the real thing that we focus on is how are they comparing on the 5 and the 10-year, and of course, not surprisingly, they've pulled ahead. The international equity did really well over the quarter, basically neck and neck for the 5-year. A lot of that was really some of the returns just for one small period. So when you include more years and you look at a longer horizon, the international equity pulls ahead. The total bond fund, this is one where it tends to be a lot closer. So they outperformed a little over the quarter, basically neck and neck over the 5-year, very slightly behind the median fund for the 10-year period, but definitely within the range of what we would expect. And just turning back on this total bond fund, one of the key differences between this total bond fund versus a lot of their peers, and I think we're going to see something interesting next quarter, is that the Vanguard Total Bond Fund really tries to limit its allocations to investment grade bonds. So the bulk of the assets are really high quality assets, either US Treasuries or really highly rated corporate bonds. Some of the other median funds, they tend to, especially when markets are doing really well, they tend to invest larger allocations in high yield or non-investment grade bonds. Those do great when the stock market is up, but when the stock market really starts to decline, they can have much greater downside volatility. So I'm really interested to see how this comparison looks next quarter,
at the end of Q1.
Yeah, at the end of Q1, depending on how much this volatility persists. Short-term bond funds, same sort of story, basically neck and neck over the quarter, over the 5-year, and they pull ahead over the 10-year. And you tend to see them outperforming a little bit more on the short-term side. You tend to see it's maybe a little bit less common for some of the bond fund managers to be taking longer duration, which increases risk, or again, increased credit exposure. But the big thing that we always need to pay special attention to are how are the target date funds, because this is where,
as you just said, 75% of the dollars
and about 85 to 90% of employees are totally invested.
Yep.
So over the quarter, coin flip, Vanguard seems to always, seems to quite frequently even win on the coin flip.
That coin flip. Okay.
Over the quarter, they slightly outperformed the median fund. But when we look at that 5-year across the board, they're really very strong performance relative to the median fund. And the 10-year, similarly so. What's interesting about the Vanguard target date funds is, they've just been so consistently managed, and they've had such low fees with such strong performance that I think now it's 5 years in a row that they've held the gold star rating from Morningstar. Very few funds have done that 1 year, let alone 5 years in a row. They're also in the top quintile over the last 10 years of returns compared to other target date funds. So they're definitely trouncing. That means that the 10-year return beat 90% of all other target date funds, which is quite a feat. And the word is out. We're now not the only ones that have recognized that the Vanguard target date funds are really a gold standard for retirement plans. Now in aggregate, I think basically 1 out of every $3 in target date funds is in a Vanguard target date fund, and that's only accelerated. Last year, out of every $10 that went into a target date fund, nearly $6 went into a Vanguard target date fund.
So a lot of people have really come to appreciate the Vanguard methodology, the focus on keeping costs low,
and the consistent, steady hand on the process side.
Yep.
So that's a quick overview of how the investments have performed. Let me pause there for a second. Any thoughts or questions about the performance of the investments? Okay. So I wanted to then end with some of the key takeaways, especially as we think about the increased market volatility that we're currently witnessing now. So, as we've said multiple times, the vast majority of the employees are in the target date funds. And the reason why, since day one, we've recommended these target date funds is because they do a great job balancing growth and safety. There are two ways we look at it. The first is, well, what's the mix of stocks and bonds for different ages? Secondly, when you take a look at their bond portfolios, we want to be really careful and analyze, well, how are they investing those bonds that they do own? There are some target date funds that have had really strong performance in up markets. And when you lift up the hood, and they seem to have similar stock bond allocations to a Vanguard target date fund. But when you lift up the hood and you look at, well, what bonds are they exactly holding? What you see is often a lot of target date funds will juice their returns by having a sizable allocation to non-investment grade bonds. Vanguard doesn't do that. They feel that the target date funds, the bond allocation really should be focused primarily on high quality investment grade bonds. So they have very large allocations to US Treasuries. What that means is when we are going through markets like we are right now, there often is a flight to quality, and that benefits the US Treasury bonds. And so their bond allocations tend to perform better when the equity markets are collapsing than some other target date fund managers that also have bonds, but their bonds tend to be a lot riskier and a lot more highly correlated with stock performance. And that really played out. So when we selected the in the past, especially when we look at the 2008, 2009, and then 2010, during this time period, Vanguard's significantly outperformed most of their peers. So I like to take a look at the 2050 fund, which back then was one of the riskier fund. It was at the very end of the spectrum. So it was the riskiest target date fund that they had at that point. And Morningstar does an annual target date fund industry report. In that report, Vanguard literally beat out that 2050 fund, beat out all of the other funds except for one, and they were like neck and neck. I think they lost it by like 30 basis points. And the return differences were extreme. There were many other funds, while Vanguard was down 20%, which was really tough during such a market decline. A lot of other funds, or I guess for the 2050 fund, it was more like 30%. A lot of other funds had dropped by more than 40%. And that's a lot of it is attributable to their risk posture in good and bad markets. And then when you looked at the overall, not just the downturn, but also the recovery, they did extremely well, both when the market was down and then also when it was recovering. And they literally beat out 85% of all of their funds during that time period. So really strong performance in the downturn. And that should all give us comfort as we're going into another volatile period. Not only have they done well when the market's been rising, but they also do relatively well when the markets are declining. So those are some of the key takeaways on our end. Let me pause there again. Any thoughts or questions on the investments before we turn our attention to, I know what Jeff is really excited to share, which is the new product stuff that he's been working on. Have any of you been getting any questions from some of your employees about the market volatility? What are people saying around your offices? Okay.
Sounds like not too much.
Not too much. Okay. Well, let's turn.
Which is actually, to be honest, that's actually a pretty healthy thing. So
Yeah.
It seems like people are aware the 401k is a long-term proposition. They're not going to get too caught up in the ups and downs of any given week.
Perfect. Good. Well, let's move on then, Jeff, to the product enhancements.
Great.
Oops. Pause there.
You're going to cut over to the demo.
Mm-hmm.
Yeah, why don't just go ahead and bring up the demo.
Cool.
So I'm excited to take a minute and just preview with you some new features and enhancements that we're working on. And many of these are features and enhancements that were really coming from some of the feedback we've been hearing from the folks on this call and other clients that we work with who have said that while we appreciate very much everything we're doing, they're interested in getting more visibility and more clarity and transparency to some of what's going on behind the scenes. And so we have been working on enhancing the website that we make available to the employers so that it can really help you understand two things more clearly. One, how we're helping your employees, and two, how we're helping you, and in particular with the administration, compliance, and making sure that you are audit ready. And
the one thing that I would add is a lot of the genesis for this is, since day one, we've been always doing a lot of work behind the scenes. And for some of our clients, they're just so thankful they don't want to even think about it.
Yeah.
But then there are others, and I see some of you on the call.
On the call today, yeah. Who have said, I'd like to have a little more visibility into what you guys are doing. We know that you're doing a lot. Can you show us a little bit more of that?
Yeah, and that was really the genesis here is really to provide much greater transparency into what's happening behind the scenes so that you never really have any question that's unanswered.
So towards that end, here's what the new website that we're working on is going to include, some of the key features. Revamped homepage that at a glance will let you see how we're working and engaging with your employees. You'll be able to see quickly the participation rate, average savings rates, and how many of them are appropriately invested, much like we were just talking about the importance of having people in those target date funds so that they do have an appropriate allocation. And also to be able to see how we have made some improvements to that over time, to be able to see changes in all of those key dimensions as we work and engage with your employees.
And this was, I remember we shared this recently with one of our clients who is an HR exec, and she was so excited because now it's going to be a lot easier for her to show the impact that she's making to the rest of the management team. And for a lot of you, the impact that you've been making by hiring us and helping us engage your employees is quite phenomenal. Generally, we often see savings rates in total increase by 2x when you look at the total amount of payroll that's saved. And so this hopefully just makes it a lot easier for you to communicate to the rest of the team the impact that you're making on one of the most important benefits you provide.
In addition, we've greatly enhanced the sort of visibility and transparency into all the work that's going on behind the scenes to keep the plans compliant. Starting with what we call our payroll X-ray. So as many of you already know, we have the integration that connects the payrolls with the 401ks. Every time you're running payroll, we're running over 44 checks on that payroll to make sure that the investment elections, that the savings elections that people have elected at the record keeper are matching what's in the payroll system. We're looking at the match that is being calculated, make sure that the match formula is being followed correctly and that doesn't exceed limits. We're looking at any loans that have been set up. So for every payroll...
Wait. You're saying 44 payroll checks?
At least 44 payroll checks, and we're adding more every time.
Well, I want to see them.
Okay. So in the payroll X-ray, every payroll that you run, we're going to go ahead and we have the detail breakdown here that shows how much of that was pre-tax contributions, post-tax, as well as the different checks that we run and the result of those checks.
So wait, when we scroll down then, you're able to see all of the checks that were performed on each and every payroll file with validation that each check was passed.
Right. So
what happens if we don't pass it?
Okay. So there are times when one of the validations will flag an issue. So as an example here, we can see that there's a couple of issues on the September 15th paycheck. So you'll be able to look into that and see what some of the issues are. In this hypothetical case, Jeffrey Thomas had at the record keeper a 5%. That's what he had elected. But in payroll, there was 6%. And that's a discrepancy that our X-ray would flag. So we need to look at why that happened. And then we can go ahead and say, you know what, we have a resolution for that. It turns out that he submitted a paper form that the HR team hadn't turned over to us. So actually, the issue's closed. We can attach any documentation and update that, and now that issue has been resolved.
So who's doing that?
Well, this is actually what our team does. Our software handles much of this, and then our operations team can work on any issues that come up that need some sort of investigation. We'll do all the work. You'll just be able to keep track of what's happening here. And of course, if there is something that we need your help with, we would reach out to you. But the goal is, and not the goal, what we do is then resolve those issues so that everything is either verified, means it passed the check the first time, or if there were any issues, they've been resolved, and you're able to log in here and track the progress of every payroll, as well as when it was uploaded, and just keep great tabs on what's happening behind the scenes.
Got it. And so then this icon right here, audit ready, just means that, yep, if the Department of Labor comes in, all of the payroll data is completely audit ready.
That's right.
Great.
Yep. In addition to the payroll X-ray, we have the fiduciary documents that are available. So every plan needs to maintain these fiduciary various documents, such as the plan documents, any contracts or agreements you have with service providers, participant notices, and you'll have access to all of them right here. Again, if the Department of Labor comes for an audit, all you'll have to do is all we will do is have to click the print audit packet button. So we collect all the documents that they're going to request as part of that audit.
Fantastic.
In addition, one of the things that we're spending a significant amount of our time on is making sure that we're handling all of the plan administration for you. But many of you have said, I'd like to know more and see what's actually happening. So we're going to have this new plan administration hub where you'll be able to keep tabs on exactly what notices we're sending to whom, when, etc. So for example, at the end of the year, there are annual notices that need to go out. We will have an indication right here as to the date that they were sent, how many people received them, a copy of what was sent. And if you want to look at see who actually received them, you're able to see each employee, the email it was sent to, the delivery date, and whether or not they even opened that email. Similarly, as we're calculating eligibility and contacting new employees, we're tracking all of that here so you can see when they were hired, our calculations as to the plan entry date, when we notified them, and whether or not they enrolled. Also, one thing I want to point out is that the investment reviews, like this quarterly investment review, they'll all be posted here. for your review. If you aren't able to join the call, but you want to see what was discussed, you'll be able to go ahead and pull down the review notes here. And all of this is stuff that will be tracked on your behalf. There's nothing that you need to do. It's just here for those of you that are interested and want to see what's happening. And we'll also have proactive notifications that go out that summarize this so that once a quarter, you'll get a snapshot similar to what we've been doing, but we'll update that quarterly snapshot to give you more visibility into some of the administrative activities and how your plan is progressing.
One of the things, Jeff, that I really like most about this is, for all of you that are on the call, that you know just how much work needs to be done to keep the plan compliant on a day-to-day basis. And you understand the risk, particularly with the heightened environment of increased DOL audits that the organizations take on if the plan is not compliant. Bet dollars to donuts that most of the other executive team doesn't particularly understand either of those two factors. And so again, this is a great way for you to be able to show the rest of the team, not only are employees using it and the great impact that you're making on employees' retirement outcomes, but all of the work that you are having done on your behalf to make sure that the plan stays compliant.
So we're very excited by some of these. We are certainly interested in getting feedback as this feedback is what we're showing you here, as well as we begin to deploy this. And you'll begin to see some of these enhancements coming out at the end of this quarter, early next quarter, as we work on completing the development and rolling it out.
Mm-hmm. I see a question from Craig, which is, will there be, so for some of our clients, it's not fully integrated payroll.
Yeah.
And you're uploading payroll files.
Yeah.
And can you show Craig how that would work?
Sure. So there is going to be a place here to upload payroll files. You'll be able to, first of all, you'll get an email that says it's time for you to upload your file. You click on that, it'll bring you right here. You'll be able to pick the file that you want. You'll go ahead and it'll preview. You'll load the file right here. It'll say, here's what's in the file. If that looks right, you'll confirm. And it'll say, great, it's all set. And then you'll be able to see on the payroll x-ray the status of that file.
Fantastic. Did that answer your question, Craig? Awesome.
Right.
Perfect.
Right.
Well, so I'm dying to know one thing.
Go ahead.
What's something that Jeff might want to consider adding to this fiduciary vault? Is there anything here that you wish you had access to that is not immediately apparent? Okay.
So I know that there are going to be things here that are people are going to really love. I also know there will be a few things that people say, I wish there was X, Y, or Z. Mm-hmm. We're very interested in hearing from you as we begin to deploy this. We're in advance. If you have questions, suggestions, please let us know. We really take your feedback very seriously. It guides us in what we build. And again, much of what we're developing here is really based on the feedback we've heard from some of the folks on this call and the other customers that we work with.
Okay. Well, are there any other thoughts, questions, concerns, anything else that anybody would like to bring up that we can talk about here as a team? Okay. All right.
Great.
Well, as always, please, if you think of anything after this, don't hesitate to reach out. I see one from Craig. Craig, we're going to send you a donut for being so interactive. Would be helpful to get better info on fees taken from participant accounts rather than just fee. Okay, so I like that a lot. So and I think this is also really important. So right now, a lot of the data on fees really exists in the statements that are sent out both to participants. But I think you're right. Given the importance of fees, this certainly could be something that we could consider adding to the dashboard.
Yeah, thank you.
I like that. Any other thoughts or suggestions? Okay. Well, on that note, we'll sign off, and as Jeff mentioned, we will pull up the and we'll add the recordings and the files from today's fiduciary vault, or from today's call into the fiduciary vault, so we make sure that you have a complete record of it. And then I guess the only thing I'll end you with is the good news. So 20% or 20 minutes before the market closed, and it looks like we're back in the green. Back in the green. So
Okay.
We'll see how that holds for the next 15, 20 minutes. No predictions on my end. All right.
Great.
Thank you all so much.
Thank you very much.
Oh, I see Mitch. Is there a way to report an overall individual plan performance? Absolutely. Mitch, what we could do is we should really think about adding that. And when you think about overall individual plan performance, were you thinking more investment performance? Were you thinking other metrics, like, or is it mostly investment performance? Got it. Okay. Yeah. No, I think that that's another good thing that we could currently add. I know right now all of the individual participants get their individual investment returns, but I think aggregating that across at the plan level is a really good idea. I think generally what I consider, I think that's a really good idea. Cool. Anything else from the team before we sign off for the day? Okay, perfect. Well, listen, thank you all for joining us for another quarterly investment performance review. And I think what we'll do is take a look at both suggestions from Greg and Mitch, and then maybe share with you all when and how that might be incorporated into the next iterations of the dashboard. Okay, thank you so much.
Have a good afternoon.